Good afternoon, everyone. It is my pleasure to welcome you on behalf of the Nova Center on Business, Human Rights and the Environment to the Capital Market panel of the first annual Conference on Business, Human Rights and Sustainability. My name is Roman Bambinov, and I'm a research assistant at the Nova Center on Business, Human Rights and the Environment and a master's student in Law and Financial Markets at the Nova School of Law. This webinar will focus on corporate due diligence and capital markets. As any other business organization, institution, or investors have responsibility to respect human rights and environment throughout their conduct and operation. This is the final concluding session of our first annual conference, and this conference would not have been possible without our sponsors, PLMJ, as well as Portuguese Chambers of the Commerce and Industry, as well as our partners NOAA for the Globe and SEDIS. I would like to thank all our invited guests for joining us today. Our panel today is comprised of stellar experts. It is now my great pleasure to introduce our chair, Bruno Ferreira. Bruno is a managing partner and a partner in the banking and finance capital markets practices. He specializes in advising on complex transactions in Portugal internationally, combining transactional and regulatory advice with advice on financial issues, including project finance operations, leverage finance, asset-based finance. Bruno has a law degree from the Faculty of Law of the University of Coimbra and a master's in banking law from the Faculty of Law in the University of Lisbon. Bruno is a member of the Portuguese think tank Governance Lab and the Portuguese Institute for Corporate Governance. He is also director of the Corporate Law Association in Review, which publishes one of the most prestigious legal journals in Portugal. Bruno, thank you so much for accepting our invitation, and now the floor is yours.
Thank you very much, Roman. It's a pleasure to be here on this last panel of the Conference on Business, Human Rights and Sustainability. This is a really exciting opportunity to have a great discussion about corporate due diligence and capital markets. And congratulations to Claire Bright and also everybody else that organized the conference, which is really interesting and successful. We have a great set of panelists today to discuss this topic. We have Isabel Ucha, who is the Chief Executive Officer of Euronext Lisbon and Euronext Securities in Porto. She is also a managing board member at the Pan-European Exchange Group, Euronext Envy. Cristina Almeida is the head of platform at Maze, which is an impact investment company based in Lisbon that accelerates and invests in solutions solving for the greatest social and environmental challenges of our time, and is a great company too. Catarina Fernandes Alves. Catarina works as a professional in corporate sustainability and sustainable finance in the consulting firm Systemic, and is one of the co-founders of the young-led association called Lidera. She believes the main key to a more sustainable and human-centric economy is to change the financial system. And last but not least, Danielle Essink. Danielle is a director at Robeco's Active Ownership Department. She has over 10 years experience in engaging companies on human rights related topics and encouraging them to operate with greater awareness and respect for human rights. She currently has a specific focus on the ICT sector. Danielle is also an advisory committee member of the Investor Alliance for Human Rights. She holds a master's degree in law and business administration from the Erasmus University in Rotterdam. Thank you very much for participating in this panel. Unfortunately, Isabel Ucha is not able to participate live with us today, and she's shared a video with her speech, which we're going to play right now.
My apologies. I think I didn't put a sound, so I'm going to restart the video. Apologies about this.
Good afternoon to all of you. It's a great pleasure to be able to share with you some notes on the role of stock exchanges in promoting sustainable finance, and in particular with an emphasis on human rights and how investors are scrutinizing company behaviors. I really regret and apologize for not being able to be in person with you today for the debate, but I'm sure it will be very stimulating. Today, I will organize my presentation around 3 points. First, I will briefly inform you about what is Euronext Group today. Second, I will remind you about the role of the capital markets and its relevance in financing the economy, with a particular emphasis in financing the energy transition and sustainability. And third, I'm going to give you a brief snapshot of how capital markets and Euronext in particular are contributing to the huge challenges of climate change and making sure we have a fair transition. In the last few years, Euronext has changed significantly, has grown, which many of you may not have followed. Euronext is now covering 7 regulated markets: Portugal, France, Belgium, Netherlands, Ireland, Norway, and Italy, and has offices in 18 countries. Euronext is building the leading capital market infrastructure in Europe and the central pillar of the Capital Markets Union in Europe. How are we achieving this? Well, we have been building this single trading platform, a single rule book, and we are regulated by a single college of regulators. And this had made possible to build the largest liquidity pool for equity trading in Europe. And why is this important? Well, for 2 reasons. Because first, listed companies have access to the best financing conditions due to this large liquidity pool. And second, investors find in Euronext greater liquidity and more investment solutions. Euronext is now the preferred exchange for the admission of technology companies and has the largest SME franchise. I would like to start also by reminding you about the fundamental role of capital markets for companies. And this is financing business, financing investment, financing growth. In addition, access to market offers visibility and credibility, and can be very interesting for attracting and retaining talent. And why is this again important? Because the energy transition and the climate and social challenges that lie ahead of us will require huge amounts of investment over several decades. And only capital markets have the capacity to channel and to attract volumes of savings towards these very large investment challenges that we will all have. Just to remind you that the big winning companies of the digital revolution have been financed through the capital markets. Just think about Google, Microsoft, Amazon, and in Europe, Adyen, Atos, and many others. Only in Euronext, we have 700 listed technology companies. The climate and the environmental revolution will demand a profound change in our society, in the industrial processes, in the energy resources. And many companies in the last few years have already resorted to the capital markets to finance and materialize this transformation. Just think about Portugal, EDP Renewables, Green Vault. Only these 3 companies have raised over 3 billion euros in capital in the last 18 months. Euronext has clearly been aligning its strategy and activities with the United Nations Sustainable Development Goals, and more recently with the Paris Agreement to address climate change. We have organized our strategy around 5 impact areas and 12 SDGs. So these impact areas are our markets, our environment, our people, our partners, and our society. As a regulated market infrastructure, we are regulated by various regulators. We have licenses to operate from our government. So we do guide all our activity by the highest standards of ethics and good governance. After all, we have to lead by example to the capital markets, to listed companies, to market members, and to investors. Additionally, and within the areas of impact, our people and our partners, we are placing a special focus on human rights and diversity. And this connects with dignity and respect in the workplace, providing opportunities for growth and career development for our employees, to develop care policies to our employees, and diversity, which I will come back to in a few minutes, and also in the dialogue with our suppliers, which is very important to progress in these topics. And I would also like to emphasize that we face increasing scrutiny from our investors on ESG themes and indicators and KPIs, including those related with human rights and diversity. In the end, diversity is a form of human right. Now, talking about diversity, I would like to just explain what does this mean for us. For Euronext, diversity means gender diversity, but also cultural diversity, experience, religions, skills, academic backgrounds. These are all very important dimensions of diversity. But specifically on gender diversity, we are working in sectors, finance and technology, where there is the greatest gender imbalances globally. But recognizing that, we have been making great effort, a very determined effort in the recent years to reverse this situation in our own company. And let me just give you a few examples. Until 3 or 4 years ago, we didn't have any woman as CEO in Euronext countries. Today, we have 3 out of 7. We didn't have a woman in the managing board of Euronext. Now we have 30%. And we only had 1 woman in the supervisory board. Today we have 40%. We will continue to make very determined and structured efforts to continue to improve gender balance in our company. Now let me turn to our products and services and to our strategy. Euronext's current strategy is designated growth for impact, because we want that ourselves as a company and through our products and services to increase our contribution to the sustainability goals of the United Nations and to the ESG efforts. In this sense, we have been introducing ESG approaches and criteria in all our products and services, and just to mention some of them, in our ESG bonds, in our ESG indices, in offering ESG ETFs, certificates, derivatives, and in helping financing companies which are most linked to the energy transition and to facing the social challenges that lie ahead of us. And as you can see from these slides, these products have grown significantly, which shows that on one side, our investors and the market in general are increasingly adopting ESG in their investments, but also that we are able to anticipate and to develop products and services to address these challenges. And let me give you another example. On the indices, for example. Indices are also a good product to align with the ESG and with the climate ambitions. The Low Carbon 100 Paris Aligned is an index that follows the 100 companies with the lowest carbon emissions. This index includes in its methodology the exclusion of all companies that do not respect human rights and labor rights according to the United Nations Global Compact principles. I would also like to take this opportunity to explore with you more detail about our ESG bonds, which is a financing instrument that has been growing significantly over the past few years. What are ESG bonds? How are they issued by companies? These bonds are issued to finance projects that have positive environment or social impact. For example, investments in renewable energy or in social housing or in education for more people. These bonds are issued with environment and social KPIs and have to report on them every year. And several Portuguese companies have also been issuing this type of bonds. EDP, for example, Altri, Grupo Pestana, Grupo Amorim, and now Motengil, who is offering an ESG bond dedicated to retail investors these days. And Euronext offers 4 sections of ESG bonds: green bonds, social bonds, sustainability bonds, and sustainability-linked bonds. As a final note, I would like to leave you with 3 remarks. First, capital markets are a critical pillar in financing the road to sustainability, and that includes also the human rights progress. Second, investment products will continue to integrate ESG criteria more and more, covering more products and in a more rigorous way. And third, institutional investors and increasingly individual investors, citizens as well, are very committed to adopt ESG in their investment decisions. Thank you so much for your attention, and I wish you again a great session.
Thank you very much. This was a great introduction, especially because we got to see how relevant and important capital markets is, both from an institutional investor and the retail investor perspective. I think we could start now with the questions to our panelists. And I think starting with the institutional investor side, my first question would be to Danielle, to get us a little bit of flavor on how actually human rights due diligence is conducted in practice by asset managers. And this from 2 perspectives, both from how you perform your own due diligence in your investee companies and how you also help your investee companies trickle down these requirements and also carry out their own due diligence on human rights.
Yeah, sure. Happy to comment on that, and thank you very much for the opportunity to share my views from the investor perspective. Maybe a little bit of background. So I work in Robeco, which is an international asset manager that actively integrates ESG into its investment decisions, and also engages portfolio holdings to improve corporate behavior. I work in that latter part, so in the active ownership team, and my day-to-day job is to engage in dialogue with portfolio companies on their implementation of the UN guiding principles. That's really for us the key framework here. So we're actively asking our investee companies about their human rights due diligence, as we feel it really helps us investors to identify and understand and assess risks in our portfolios. This is quite a complex process. We have around, let's say, 5,000 holdings at a certain moment in time. It can be sometimes a little bit less or more, but that already shows that it's quite a substantial effort needed to do that. And we use data providers, but also a lot of desk research. I'll share a little bit more on that later. But it's really key for us that when we don't see any evidence of appropriate due diligence or oversight, we are really concerned that human rights risks are not being appropriately taken into account by companies, identified and addressed. Well, as we mainly invest in listed companies that trade on stock exchanges, we just heard a lot about that, and I agree with many of the comments made. We thereby provide obviously capital to those companies, but we don't have a very direct relationship like being on the board of these companies, for example, like you would see perhaps in private equity or venture capital. Our first point of contact with companies is usually through the investor relations team, and we connect often also with sustainability and human rights specialists in these companies, and meet board level representatives where this really adds value. But these are enormous companies with also a lot of shareholders. So this is slightly different than when you are more directly financing these companies. I wanted to spend a little bit of time to understand why do we focus, right? And Roman pointed it out already in the introduction. We actually have an obligation under the UN guiding principles, and we really see this as an important guidance for us. I think it's been a couple of years ago that the UN working group really called on investors to start implementing human rights due diligence as part of their responsibility, both in their own operations, as you pointed out, but also more systematically require effective human rights due diligence by the companies they invest in. And I think that's really an important part where we can really create leverage. And to hopefully also coordinate really with other organizations, platforms to ensure alignment and meaningful engagement. And I think that especially with the large scale of companies, we need to look at collaboration both with other investors, like-minded investors, but also with civil society organizations to really get the right information to our desks is really key in our approach. But it does get really complex sometimes, and I wanted to share maybe some challenges or some practical experience with you as well. In our team, we're fortunate to have quite a large team, so we focus on ESG, but we get to specialize. So on the social part, social pillar, as we call it internally, we have 4 people, which makes it possible for me to really focus. So indeed, as mentioned in the introduction, I do a lot of work on technology and human rights. But I also started looking this year more into, for example, high risk and conflict affected areas. Unfortunately, a topic that is really important at the moment with a lot of conflict around the world and how companies are operating there. One of the challenges we see is really the right data. I'm working in a big investment firm. Everybody likes numbers, put it in an Excel sheet and we understand it. But with human rights, that's really, really not so easy. So we just finished, for example, an internal project where we looked at around 250 companies, screening them one by one, really desk research, qualitative research. And all those companies operate in high risk or conflict affected areas. And what we notice from, for example, from our regular data providers that we get, and those are ESG data providers. This is not like Bloomberg or financial data. This is really already ESG data. We really see that they don't flag these companies or these issues as a very high controversy or a high risk. But we actually, from our research, see very significant real impacts on people when companies are actually fueling conflict, for example. And while we see that the financial impact on companies can be really limited, the impacts that they have on people can actually be really big. And that really shows that it's not so easy to put this in numbers or screen via a data provider and just get some scores and understand what companies you should be focusing on. So I think that's one of the main challenges. We solve that by doing a lot of our own research, but also with this network of international other investors and civil society organization, learning from fora like these as well. So really a broad range, but that is really, I think, the benefit of being in a larger organization. And I do see the challenge for people that have to do ESG in one person, but also screening large amount of companies. I'll leave my remarks there for now.
Thank you, Danielle. Those were very interesting insights, especially on the practical challenges that might arise. Cristina, the next question would be for you. And I think comparing what's the experience that Danielle and such a large institution that invests mostly on listed companies has, how would you compare this to your experience at Maze and the experience generically of a VC investor with a different type of company in a different stage and with the different size of investor and investee companies.
Yes, hello everyone. So before I jump into the answer, just to give a little bit of context on Maze. Maze is an impact investing company, as Bruno said, and it was founded in 2013 by the Carlos Gulbenkian Foundation. And we have 3 areas of work. One of them is indeed the venture capital fund that I will talk about today. We also do acceleration to impact startups, and we also work with the government in our government performance area, which is actually how we started. So we are an impact company turned into an impact investor, if that is fair to say. And I manage the platform of our VC fund. So basically all of the non-financial services that we provide. So picking up on your question, I think the main difference, well, venture capital invests in venture projects in early stage startups. So I think it differs in the level and the type of risk that is involved. So we follow a power law in terms of returns, which means that 9 of each 10 investments we make will fail, and only 1 of them will generate the venture returns for the fund. And so I guess asset managers, on the other hand, can control a little bit more the level of risk, bundling multiple investments, and we work in a different way. So I guess the difference for us, we look after the venture products, and I think asset managers look after their clients' wealth. So in our case, as Danielle was saying, often we sit in the board of these companies, so we get to influence the outcomes, the business and impact outcomes that these companies deliver. Whereas maybe asset managers just wait for the market to deliver what it would deliver anyway. So we have this proximity to investees. Also, the available knowledge. So in the stage that we invest in companies, sometimes if it's a pre-seed ticket, we invest in an idea. So we mostly invest in people. So the kind of information that is available, and if the solution succeed, it will change the market as we know it. So if we think about all of the Google companies and Facebook companies, they have changed our world. So we have to make decisions about social and environmental outcomes with very little information. And we have to focus on the people that are delivering this mission and their ability to stay true to what they want to do with the startup that they're creating. So, I mean, in terms of the impact management that we do, it impacts our due diligence, it impacts the way we communicate. We have to be very transparent in terms of what we do. It impacts how the companies report to us and then how we report to our LPs. So all of our working processes have impact embedded to make sure that we stay true to our mission, but maybe I can dive into that in more detail later.
Thank you, Cristina. That was really interesting. I think we just got a very interesting description of the type of procedures and challenges that we have in a large asset manager and in a VC investor to make sure that actual procedures and adequate procedures are put in place to make sure that both due diligence requirements are complied with and impact investment missions continue. And I will now ask Catarina, what do you feel, because we all know that there's a big buzzword generally around the sustainable investment. How relevant would you say is greenwashing in the current capital markets environment? And do you think that the procedures that and the way that the investors operate have started tackling these challenges, and how important this would be in the current market?
Thank you, Bruno, and thank you also for the invite. I will also do a small introduction on what I do. So I work in corporate sustainability and sustainable finance in Systemic, which is a small, but it's getting bigger consultancy in this kind of issues. We used to be 2 people last year. Right now we're 9. And so we also work with capital markets on this kind of issues and how can we integrate ESG factors in investment decisions, not only in capital markets, but also in the banking sector, for example, or other types of financial institutions. The relevance of greenwashing, I think it could be a moment, because there's always we have to adapt, and throughout the getting into new regulations and getting into new trends, there's always a period of transition where we need to gather a lot of data. So, and when we talk about greenwashing, it can also be about social issues. So we could also be talking about human rights. But there's, in the type of analysis that are usually done, first of all, the final interests of capital markets is financial materials. So they will only mostly care about, even if it's ESG issues, so environmental, social, governance issues, they will mostly focus on issues that are financial materials, so that have a financial risk, which means that if there's not a, for example, in terms of reputation, if human rights is not a focus for a specific sector, they won't care a lot. So there's this question of just like the financial material of ESG issues, and anything that it's not financial material won't really be considered. And sometimes it's also hard to quantify what is the financial materiality of a certain issue. And right now we've been talking a lot about climate change, and we're working on incorporating ESG risks on financial analysis to give investors the perspective of how this, of the financial materiality of this. But so when it's hard to quantify something, it's then hard to evaluate if something is providing the value that it actually says it's providing. And I think this is one of the things that are happening right now. I think there's a lot of greenwashing in a lot of products that are being made, but that's also because there are not a lot of standards. So those standards are being created. And although I believe that things are not at the right stage at the moment, I believe we're walking towards that. And as we get standards, international standards, comparable data, I think it will get better.
Okay, thank you. And do you feel that, for example, the taxonomy regulation and the sustainable finance disclosure regulation are steps in the right direction in order to tackle the type of difficulty that you've been describing?
Yes, exactly, because the taxonomy, it's basically a classification system that technically describes what is sustainability, because if we think about it, there's not a exact definition, and for each sector, economic sector, it will mean something else completely different. So the taxonomy is a baseline super important for not only for companies, but for the financial market, because that way you'll be able to quantify sustainability and you'll be able to identify what are sustainable activities for a certain sector and what are not sustainable activities. And once we have that, and we already have for a few of the objectives of the European Union, because the taxonomy is a classification system still that it is only being developed in the European Union. It will help to bring that transparency that we need for investors also to not be worried with the greenwashing thing, because what I've been experiencing is that investors and even credit analysts and credit agencies sometimes are a little bit skeptical of some of these sustainability bonds, for example, because these standards are not yet incorporated. So yeah, definitely the taxonomy will help on that. It will give us basically a common language, and that through that common language we'll be able to develop standards and to do things right, kind of. But yeah, I could talk a little bit more about the taxonomy and how I think it could help making the financial system, capital markets as well, but also other types of financial institutions, how they could kind of even drive sustainability, because the CEO of Euronext, she talked about that, and that's true. I mean, the future of tomorrow in a capitalist world is based on the investments that we do today. So if we shift the financial incentives today to sustainability activities, we will have a sustainable future. If we don't do that, no matter how much policies we make, no matter how much commitments we make, that won't happen. Because also it's less riskier to invest in mainstream solutions and technologies because they're less riskier. And so then the technology breakthroughs and the breakthrough solutions to, for example, climate change, they will be a little bit more riskier. So we have to kind of balance so that there's a chance for these technologies to develop and to become massive in a way that then can replace the way our economy function. Yes. I could also talk a little bit on the sustainable finance regulation, but Bruno, maybe you could.
Yeah, no, go ahead. I think we have time. I think it's because it's great to see how the taxonomy regulation, which is just making sure that everybody's talking about the same thing when they're talking about the specific subject, and how that then moved on to the ESFDR and actually translated into something concrete, which probably helped you in your job in working with companies to make sure that this was on top of their agenda, right?
Yeah, exactly. So the European Union launched this year a new sustainable finance package that brings different regulations, and one of them is the sustainable finance disclosure regulation, which targets specifically the financial market and also their advisors, the financial advisors. And so this will oblige financial players to disclose how sustainability is embedded in strategies, policies, and procedures, and also how each product contributes to sustainability. So this is when we can bring taxonomy, and the sustainable products, sustainable financial products will be based into these rules. So then we'll know. And also, this is already into place, and something that will come in the end of 2022 is that they will have to report the sustainability impacts that are considered in their financial products, so how they incorporate that in their investments. And I think this is where the financial system then can have almost a stewardship role in the companies, because if they have incentives, even from the Euronext, as we could see from the presentation, this means that banks, but capital markets in general will have two options. They will either disinvest, or they will help companies to be more sustainable, and they will kind of help them to make this transition. And I think this is a very interesting point, because that means that financial companies could help to drive this change forward. Yeah.
Thank you, Catarina. That was really interesting. And I think that when we talk about the role that institutional investors and financial intermediaries play, I think it would be interesting, Danielle, if you could give us just a perspective. I know you have a fairly large team, as you were saying, that allows you to focus on specific questions. How would you analyze the evolution within your company within the last couple of years, and how would you compare that to the rest of the industry? So is this a trend that you're seeing basically everywhere, or are there a couple of players that are a little bit ahead and more aligned that would at the end of the day make a real difference in the market?
Yeah, sure. Interesting, complex question, perhaps. Let me start with the evolution internally for us. Maybe that's an easy start for me. So I did mention we have a large team now, but obviously that wasn't the case when I started doing this work in 2007. So then we were 3 people, 1 on E, 1 on S, and 1 on G, and you would do all sectors, all issues, and trying to promotes ESG integration of your information and do everything that you can imagine under sustainable investment. So that definitely changed. And I do see that trend in more companies. So I think more investors are taking more effort into this work. I think some are really focused still on the E and the G in ESG. I think the S is upcoming. There's been many articles written about that. COVID helped that. I also still see a lot of very severe impacts. I'm not sure if everybody agrees that things are getting better, especially on the worker side. I think we've seen a lot of issues, but it has elevated those topics. I think we're reading more about it and people are looking into it more. So I think that is the positive out of the negative, I guess, that we see. I think one of the things that also really explains the evolution internally, and Catarina, you mentioned it, ESG a lot of times is about financial materiality, right? And I see also that development internally. I'm not sure if everybody in the market is already transferring in their thinking towards things like UNGPs, OECD guidelines. But for me, it's always about trying to educate internally my investment teams that are, their duty is to look at the financial performance of companies. They take ESG into account as a secondary, but I see it as my role to really educate them on, for example, the difference between saliency and materiality. And that sometimes is an easy discussion and sometimes it needs a little bit more persuasion because it's just not always a match, right? There is circumstances where it comes together, but I think, yeah, really taking human rights into account should really be that saliency approach. And that's not natural to an asset manager or portfolio manager. That's just not how they are trained. So I think some positives is that you see also in other platforms where they do, for example, their CFA exams, you see ESG more integrated there. So I think there is a lot happening to speed this up. But I think it's really important to always distinguish between those two different things. And when you talk about saliency and materiality, I think one of the concepts you hear about now a lot is double materiality. A lot of more attention is being directed to that. Really where those two concepts come together, right? So saliency and materiality come together. To be honest, I think it's very positive, but it's also sometimes also a way for people to say, well, I'm already looking at the S in ESG because I'm looking at material topics that are also salient, right? But that's not what we want. I think it's really important that to understand where those risks overlap, of course, taking human rights considerations into account is more straightforward because you're actually looking at the material risks, but as an effect also at the human rights risks. But I think it's always important to understand that you should also look at the human rights risks that don't have a material impact on companies yet. And some companies are so large that this will never have a balance sheet effect for them if they relocate a certain amount of group of people without the right precautions or the right consultation, for example. Will this have a material impact? If the company is large enough, probably not. But does it mean we should not care? I think that's the wrong assumption, right? So the human rights perspective should be front and center. I think organizations should really invest in that approach by getting the right expertise in their teams and having people constantly keep people thinking about that lens. I think it's good that sometimes we see this concurrence. Also a trend I see, for example, in the tech sector where I do a lot of work, started working in that sector maybe 6-7 years ago. At that time, discussing topics like privacy or freedom of expression would definitely not be financially material. This was just like, oh, this is this human rights language. Why are you focusing on this? I'm putting it a bit bluntly, but I think that in effect, I think was the response in the sector. We also asked brokers, so research brokers, to provide us with research on companies on these topics, and they said, well, we don't really cover those topics. We don't think they're financially material. But also internally, we saw that was a difficult case to make. But if you look now, I think both those topics, but also things like discrimination are really accompanied already by material risk like regulatory risk or public scrutiny. And I think that is really also something you see sometimes with human rights topics, that they might not be material today, but if you don't manage them well, they might end up being very material to you in the near future. And I think that is something we can use as a language to get people to pay attention to these topics. Then as a last trend or development, the ESFDR, Catarina, you're going to talk more about it, but I just wanted to share also on the investment side, I think this is really a promising development. I'm noting in my organization, but also with peers, people are nervous about it. It takes a lot of time and effort to understand, to implement, but that's a good thing because it means that, for example, the adverse impact indicators really put a human rights lens on certain topics. And we are already starting to ask companies to disclose more on certain topics because we know we need to disclose on those topics in the near future. So it's really a push for more transparency and understanding on these topics. So I'll stop there.
Yeah, that's really interesting, Danielle. And I think the question, and I think that's also one of the big difficulties, which I think is starting to change, is how you get to convince people that used to have a traditional perspective on investment that absolutely needed the materiality consideration, and the difficulties that you have of measuring those types of impacts where you don't know if the materiality or how that's going to translate as an impact in the company. So I think that's a really big challenge. I think, I don't know if you agree, but especially in the tech sector, the social media has probably transformed things a little bit insofar as it echoes and gives a lot of resonance to some of the specific questions that arise. And then at the end of the day, it's probably a little bit easier to calculate the financial impact that will have on sponsors and clients and so on. But I think that would be a big challenge that you have. And from, I don't know if you agree, the way that you are looking at this right now, it has become easier to have that internal discussion on salience and materiality, because some things that were salient, were difficult to grasp in terms of materiality, they've been having a lot of impact in the market, and you can like make reference to the precedents that existed in the market. I don't know if you think that's the case. So the fact that all of these, especially in the tech companies, all of these issues or problems that arise from time to time are having such an impact and such an echo in the media and in the social media, then it probably has become a little bit easier to convince people that the materiality trigger will be there at some point in time.
No, of course, that is indeed the case, and we use those examples across sectors and say, well, maybe it's not material here yet, but look at what could happen, right? And on the other hand, sometimes some things will maybe not be financially material, and I hope I made also clear that still we still have a responsibility to take those things into account, and that's more from a, some people would say maybe reputational, but I would say maybe what are things we don't want to be involved with. So that's also more a stance that you take as a corporate. For us, that's quite complex. I have to be honest, we're an international asset manager. We have offices across the world, across Asia, the Middle East, the US, Europe. We have quite a big spread. And what you note on human rights particularly is that on some topics, there is no global agreement on what is right and wrong. And I think that's where it's really complex for us. We want to take as many stakeholder voices into account, but sometimes these are really conflicting views. So those are areas that are super complex for us. But I think in a lot of other cases, if people agree that certain things are not the right thing, and then we should really question if we want to be involved in those companies, either through exclusions, that's an option, but also through trying to change those practices through engagement. And sometimes we have sort of a special program where we put those type of companies where we really have strong concerns about their performance from a social or environmental perspective. And we would then, if they don't improve sufficiently enough, say goodbye to those investments after a certain amount of years of trying to change that. I think first and all, we prefer the engagement routes, really to talk to stakeholders, understand the issues, talk to the company and try to improve. But sometimes you have to come to the conclusion that that wasn't successful, and then an exclusion is an option for us as well. So there's many different ways of looking at it. But I think my main message is really that we have a responsibility to look at these issues, whether they are financially material or not. The ones that are financially material are far easier to cover internally. This is far closer to our maybe heritage or way of working in the past. But we should not forget that there's other cases where we also have to come up with an opinion and make sure that we are comfortable, but also our stakeholders are comfortable with our decisions.
Great. Thank you very much, Danielle. Very interesting. Cristina, the type of work that you do in investing in purpose-driven companies, there's of course a difference from the traditional criteria that used to be used to evaluate companies. And now, in addition to just considering the financial performance of companies, you also have to value the fulfillment of social goals. How do you do this in practice, and how do you measure this in terms of your day-to-day work?
Yes, it's core to what we do. We don't believe there is a tension between financial performance and impact. So when we started to fundraise our fund and we wanted to say we're an impact fund, like the traditional investors were like, how are you going to solve social and environmental challenges and make money at the same time, as if it was exclusive? And our thesis is that impact is the greatest economic opportunity of our time. So we invest in companies where profit and social or environmental outcomes are mutually reinforcing. So if we follow our investment thesis, it means that the businesses of the future will be valued more highly than the businesses that do not solve social and environmental challenges. And so their expected value will be higher. In practice, since we work with early stage companies, we don't use ESG tools. So we assessed many tools for Maize as a whole in ways to manage our impact. And we concluded that we were going to use the impact management project framework and then use the UN SDGs as a communication tool. It's very important to say that because we invest in such early stage companies, it doesn't make sense in terms of proportionality to impose them a very complex impact framework for them to follow, because they have to create and develop a business and prove product market fit and all the things that startups need to do. So for us, really, as impact investors, we try to embed an impact discipline and mindset from the get-go. And it's really interesting that before, when we were increasing our pipeline and talking to ventures, we had to explain that we were impact investors and what was our thesis. And right now we receive inbound from ventures that come to us and say, hey, we want an impact investor in our boards. So this means that there is a demand for this. So this means that actually something is changing. If these companies want this, maybe even if it's just the fact to have a stamp of an impact investor in their board, it means that this means something to the market. So I would explain our impact approach and how we do this in practice in 4 angles. First is due diligence, then our incentive structure, which is tied to what Catarina mentioned before, then our reporting and transparency. So the first topic, due diligence. When we are doing due diligence and following this IMP, the Impact Management Project Framework, which I invite everyone to follow, it was developed for investors, and to normalize a little bit this discussion of how can we have a common language when we talk about impact, especially when we're talking about social outcomes, which are way harder to normalize than environmental outcomes. So for each investment that we consider, we analyze 5 dimensions. So what is the outcome that this company wants to deliver? Who are the stakeholders that are impacted by this social or environmental outcome? How much these stakeholders will be affected and for how long? The contribution, which is to say, if this solution didn't exist, would these people be better off or worse off because of the existence of this business? And the risk tells us the likelihood of this company not delivering the social and environmental outcome that we expect. So we analyze each company in these 5 dimensions. And after we do this, we have to agree on an impact metric. And we call this a lockstep impact metric in the sense that it translates the success of the business financially, as well as the fulfillment of the social or environmental outcome that this company wants to deliver. So if we pick an example of one of our ventures, Student Finance, which is a platform that offers income share agreements. An income share agreement is a contract through which a student receives money upfront for education, and he only starts to pay for his education once he has a job as a percentage of his income. So when we were discussing student finance, we say, okay, so what are the metrics that can translate the fulfillment, the success of this business and the impact as a whole? So we agree with the company and with other investors that we will monitor the number of job placements as well as the increase in outcome. The more job placements that student finance does, and the bigger the increase in outcome, the more money the student finance will generate for itself. So this means that this will be mutually reinforcing, and then we have just a flywheel of outcomes that come. So in this sense, we don't see in the business that we invest, we don't see the tension between impact and financial performance, quite the opposite. Then in terms of incentive structure, we were the first fund in Europe to design an incentive structure for the management company of our fund to make sure that our carry is tied to the fulfillment of the impact metrics that we set for each business. So as I said, I gave the example of students finance, but all of the companies that we invest, we have decided for 1 or 2 impact metrics. Then we do projections for the following years. And when the fund ends, and if we invest in a business that will deliver the venture returns, we will only receive the carry as a management company if the companies have fulfilled the impact and the environmental outcomes that we set from the beginning. So if all the companies decide to go rogue and do something very capitalist and non-conforming with society and the environment, our LPs will be paid, but we as a management company won't be paid. So this means that we are incentivized to be very mindful in boards to make sure that the companies are going in the right direction. So this ties back to reporting. So all of the companies have to report to us on a quarterly basis based on the impact that they're creating. So this is something that is mandatory in the shareholders agreement, and it's tied to our incentive structure. So we are incentivized to do it. And so every quarter the companies report to us. So every quarter we can have a material conversation with our limited partners saying, hey, this is the impact that we're trying to create. And then in terms, every semester we meet with our advisory board, who are our very, very critical friends that ask us all the hard questions to make sure that the investments we're making are solving material, social, and environmental challenges. And this links to the final point, which is transparency. So after all the due diligence, the management of our impact, so we don't do impact measurement in the sense that it doesn't make sense to us to take a photograph of the impact that we're creating, but more managing the impact in a regular basis. So if you go into our website, all of the companies and the projects that we have backed, we have an impact fact sheet where you can see like a summary version of our IMP analysis for each company, the SDG that they're tackling. And you can also read our impact report where we are very transparent about how we do it. So for us, simplicity is key. We're working with early stage companies, so they do not have the resources to make a very complex management of their impact. But if they have this mindset from the get-go, then it's very likely that they will continue to do so in the future. The very last point, we are a certified B Corp. So this means that it's a third-party certification that assessed the performance of Maze in terms of governance, how we treat our employees, company, clients, and the environment. And this is something, it's a very lengthy process, so it's not accessible to all of the impact ventures. But as soon as this starts to mature, this is something that we try to influence all of the companies that we work with to do the same kind of certification, because it's very different to self-report the fulfillment of social and environmental outcomes or to have a third-party certification as B Corp. So Patagonia, Ben & Jerry's, Danone are some of the big companies that have this certification, and that's also a way to be transparent.
Thank you, Cristina. I'd imagine the big challenge there, especially in the tech sector, that Danielle also knows very well, is those types of founders and startups that at some point in time do want to change and don't want to be invested by Danielle, but by some other asset manager that doesn't use ESG criteria and might some way feel that that's more profitable to him and try to change the mission of the company. But it looks like you have a lot of controls and you have that permanent discussion with your investee companies. That's very interesting. Thank you. We now have some Q&A section here. Looking at the questions, I'll try to use them by order. The first one on the taxonomy is probably could be addressed by Catarina or by whoever else wants to address it. So first one is, what is your opinion on the need to have social objectives and social do no significance arm criteria? And do you think that capital markets are aware of what it means to ensure minimum social safeguards? So this is a bit around the S and the importance of the S in ESG.
Yeah, so right now we have the taxonomy on environmental issues, but something that while in the process of making it, the EU realized, okay, but sustainability is not only about the environment. So they're also working on developing a social taxonomy. There's already a proposal on it, if you would like to check it. But what happens right now is that in the environmental taxonomy, we have the minimum social safeguards. And what is, in theory, an activity can only be considered environmentally sustainable if it complies with minimum social criteria. Of course, some of that criteria can be, I mean, for capital markets, it's easier to assess because basically, I think, and Danielle mentioned, then you need to comply with the United Nations. What is the name again?
Guiding principles.
Exactly, and the OECD guidelines as well. Yeah. So for bigger companies, it's easier. For smaller companies or for small companies that go to banks for asking for loans, it could be harder. And so that's when some social washing could happen. But yeah, it's hard to, it's mainly, I think this is the kind of question that everyone skips when they will be making this taxonomy screening. But this EU social taxonomy, I have it actually here with me, the proposal, and basically it's interesting because it touches on what you said, Cristina, on the way you do things, because it will basically try to differentiate the inherent benefits of a business, which is usually job creation, social protection, production of goods and services, and then so a company many times when they're trying to say, oh, what's your good on society, and say, oh, we create jobs, and yeah, that's true, but that's the inherent benefits of a business. But so what we will try to measure with this taxonomy is to try to understand what businesses are actually creating an extra benefits to society. Then there will be this thing called additional social benefits, such as improving access to quality of healthcare. So that's something extra, or ensuring decent jobs. So that's only giving jobs to people, it's making them decent. So it's interesting how it touches a little bit on how you work, Cristina, with the venture capital. Yeah, that's it on my side. I don't know if anyone wants to add something.
Thank you. That's great. We have then another question for Danielle, and it talks a little bit about the focus on E and G and a bit less focus on S. I think your comment before, Danielle, was that this was changing a little bit and that you saw this as a current trend, especially in your company. Do you feel that that there's something else that might be done to increase that focus and put both questions on, so the three big criteria on par and social not as left behind as it used to be?
Yeah, that's a good question, and I think at least one of my ambitions to make sure that it gets on the same level. I think there's two comments I would like to make here. One is that actually they're not as separate as they might seem. So sometimes the E has social repercussions, but also what we're trying to do internally, and that resonates generally very well with both companies and other investors, is to combine the S and the G to really talk about oversight, board oversight, the mandates that human rights team get internally within the companies we invest in to actually work on those topics, and to really challenge the companies on things like due diligence, which is almost risk management, I think. So I think bringing that all together and trying to be flexible in those three pillars, I think that is something that we are trying to do. The other very promising development that I see, and I forgot to mention it earlier, so great to see this question. And actually it answers one of the other questions that is also in the queue, so maybe I can take the opportunity to answer two in one, which was about valuation of human rights impacts. And there's a really good project by Shift, which is a consultancy really coming from the UNGP team. And they're doing the Value and Respect project. So if anybody hasn't seen that yet, they have a great website, and they're really trying to make it easier to really assess the social actions that companies are taking, because there's a lot of anecdotal reporting, which is really difficult to get through. There's some social greenwashing type of things. So I think it's somewhere with investors, but also definitely at the company side. So I think that project is really, for me, promising, and we're actively collaborating with Shift to provide input and make sure that it's workable also from our industry.
Right, that's very interesting. One of the other questions was around the IPCC report. And I think this might be interesting from a more of a consultant perspective for you, Catarina. Do you feel that the report from the Intergovernmental Panel on Climate Change has increased the sense of urgency in the financial sector too? Or is it just the additional regulation and the ESFDR that's making this, that's having this impact?
I'm not sure what's the recent findings, because the recent findings say that we're not in a good path. So I think in terms of what is the capabilities of the capital markets to achieve the investments, that's already in an early stage. So maybe we'll see the results of this work that we're talking about here later on, and those would have effect late in maybe 5 years. And we hope that will bring these scenarios back to the 1.5. Let's hope for that. But yeah, I think for the financial system in terms of risks, because climate change, and as much, the more the temperature increases, the more risks there will be for the economy, so for businesses and then for the financial system. So I think they should be worried, but because still, I mean, the financial system generally cares mostly about short-term results. And unfortunately, I don't think they are looking so much into it. But maybe Danielle has a different opinion on this.
Yeah, I think that one of the big challenges on that front is, I could call it probably, and Danielle mentioned it a little bit before, which was a sort of a double materiality washing, meaning that because, and of course the most recent conclusions on the IPCC report, it doesn't make any economic sense to build a big hotel right by the beach, where, you know, there's a place that's going to be affected. And of course, traditional asset managers using traditional criteria will pick up on that risk. It's like a basic economic investment risk. And then what we need to avoid is probably that they use that type of analysis to say that they're considering ESG criteria on their activities. I think that's one of the big risks, but I think that the regulation and the taxonomy probably is something that's a move in the right direction in order to try to avoid these types of situations. In terms of questions, there's one additional question about the EU Green Bond standard and what impact that might have on the financial sector. I don't know, Catarina or somebody else that might have an opinion on this.
I think I brought this a little bit up, but if someone else wants to answer afterwards, I think it's okay. But I think this will bring the standards that we need to make comparable, or to be able for investors to compare information and to assess the sustainability of what they call that are EU green bonds. So I think this will help on that, on transparency, on assurance of actually making an impact. And for the other question, other types of bonds, I think for that we first need to have the social taxonomy to then be able to integrate or to make a EU bond, ESG standard or social bond standard. For that we need a social taxonomy first. So maybe that will come up in the future.
Thank you, Catarina. I don't know, I think we're probably about to hit the time mark. I don't know, Claire or Roman, if we probably should just move on to closing the conference. Thank you very much to all the panelists and for the coordination and organization committee. And thank you very much for this. I will now pass to Roman back again. I think that's it. Thanks a lot. Bye.
Thank you very much, Bruno. And first of all, I would like to start with thank you very much to all the invited guests. I hope the attendees also found this session as informative as I have. And the topics which were discussed here, I think, are going to be quite urgent in the future. Secondly, I would like to mention we invite everyone to follow the Nova B Business and Human Rights and Environment on social media and sign up for our newsletter. I'm being informed that the connection is not good. Can everyone hear me? Okay, so we'll share the links to follow our center on LinkedIn and our website in the chat after a few moments. And now it is my great pleasure to introduce Celine de Graça-Pires, Human Rights Manager at BSR and Research Associate at Nova Center here. Prior to joining BSR, Celine was an independent consultant in business ethics and human rights for mining companies willing to operate responsibly in Latin America. She was also head of international relations at the World Forum for Responsible Economy. Before that, she worked for international law firms in Brazil, France, and Chile, where she advised extractives companies on permitting processes, crisis management related to human rights, community acceptance of projects, and land rights conflicts with local communities. Celine holds an attorney at law certificate from the Paris Bar School, France, an MA in business and energy law from the University of Marseille, and MA in law and business ethics from the University of Sergi-Pontoise. She's fluent in Portuguese, Spanish, French, and English. Her speech will be concluding the first annual conference on business, human rights, and sustainability. Celine, thank you so much for accepting our invitation, and now the floor is yours.
Thank you so much, Roman, for the very kind introduction and long introduction, gosh, including my language skills. Thank you very much. So good afternoon, everyone. First of all, I would like to thank Claire Bright and the Nova Center on Business, Human Rights and the Environment for the kind invitation and great honor to give the closing speech of its first annual conference on business, human rights and sustainability. And I would like to sincerely and warmly thank all the speakers and participants for the very insightful and fruitful discussion. I was not able to attend all, but the one I attended was exceptionally of quality. So I would like to close this first annual conference by saying a few words on the kind of perspectives for business and human rights and why we should embrace intersectionality and inclusiveness. And echoing the amazing opening speech of Dusu Jabula and opening speakers, I have called this closing speech, Looking Ahead, a call for intersectionality and intergenerational responsibility. So I will start with intersectionality. We need intersectionality and interconnection in the business and human rights field, in my view, in two ways. First, to better capture and address the specific and sometimes terrifying current and upcoming trends and related challenges of our own generation and the ones of the next generation. The world around us is changing, is evolving rapidly, and is more and more globalized, dematerialized with the rise of automatization, new technologies, and the increases need of more mineral and natural resources, which result, we know, in significant structural changes to the way companies do business, interact with stakeholders, and the nature of work in general. And finally, we know better than ever that the climate and our biodiversity have never suffered so much. So we need to draw on scientific research, legal studies that consider all these specific new trends, particularly to our generation, intersect and impact human rights. And we've covered some of these trends during this first annual conference: climate and human rights, digital transformation and human rights. And certainly next year, we'll have more trends: just transition and human rights, automation of work and human rights, or artificial intelligence and human rights. So it's our responsibility as business and human rights experts to explore, identify, analyze the intersection between these new trends to our generation and human rights. And how these new trends, this new signal of changes can affect human rights, so we are equipped to actually prevent adverse impact and ensure a sustainable and fair future in the use of natural resources, nature of work, and in the way companies do business. The second way I see we need intersectionality for is to capture complex and multiple violations of human rights. We know that all human rights are indivisible and interdependent, interconnected. This means that for sure one set of rights cannot be enjoyed fully without the others. But similarly, adverse impact in one human right can negatively affect many other fundamental rights. But states respond by developing laws and policies addressing each of these rights, most of the time separately. Claire Bright mentioned Modern Slavery Act in UK, Australia, the Dutch Child Labour Due Diligence Law, very recently adopted. So the majority of existing human rights instruments, both at national and international levels, still tended to actually compartmentalize human rights violation into discrete categories: modern slavery, child labor, etc. But what happens when a situation in complex global value chain, we discussed that during this conference, concern not one, but two or more rights? There is a need to take an intersectional approach to the violation of human rights, to be able to capture and understand the dynamics of multiple and interdependent combination of violation of human rights that complex and global corporate value chains allows. From my experience as a practitioner, it's never about one single violation, but several human rights violations at the same time, or a series of violations, an aggravated cycle of abuse in which the impact of the violation of one right contributes to causing the violation of another right, which further contribute to the violation of another right, and so on. So we need intersectionality to understand, identify complex causes of human rights abuses in corporate value chain and related multiple consequences to avoid partial remedies. We noticed in the field that the measures taken to remedy human rights violation are, well, often in the majority of the case, only designed to respond to the violation of one or two rights. Consider more urgent, or in case of discrimination on one ground. So the logical consequences of this approach is that the responses provided to remedy are also partial. So intersectionality will help us to map the dynamics and consequences of the combination of human rights violation or the chain of reaction of human rights violation, so we not fail to remedy it. And there is hope for intersectionality with the upcoming EU directive on mandatory human rights environmental due diligence, of which the EU Commissioner of Justice, Didier Reynders, has conferred the forthcoming publication in this the opening speech of this first annual conference. And this directive, which will take into account the universal, indivisible, and interdependency of human rights and the intersection with environment. So we will be equipped to actually answer right identification for adequate remedy. So as you see, intersectionality has not reached its limits, and we are just getting started. My second call is about intergenerational responsibility, which is quite interconnected actually with my first call. I mentioned several of the human rights characteristics, but fundamentally we know that human rights are universal. This means that we are all equally entitled to our human rights. Human rights are inherent to us all, regardless of nationality, sex, ethnic origin, color, religion, or language. Well, I would like to add another one. Human rights are inherent to us all, regardless of generation. Human rights are fundamentally universal and need to be perceived as intergenerational. The protection of human rights of our future generation, we know, is in danger. And Dusu Jabula opened this first conference with a powerful speech, concluding that we have the future of an entire generation in our hands, and this is indeed an enormous responsibility. And corporate respect for human rights needs to transcend a particular generation because it's fundamentally an intergenerational issue. The way companies do business now can shape in an irreversible way tomorrow's world. If we don't do what is right in the right way now, there are disastrous consequences for children, grandchildren that they will face. And I was thrilled to see Dusu opening this conference, Claire, because I think this sent a powerful message. It's nice to hear new voices in the business and human rights field. It's actually crucial to hear the voice of youth in the business and human rights field. We need to strengthen our efforts toward global consciousness that, while the protection and respect for human rights and the environment required a multi-stakeholder perspective that embraces academics, practitioners, companies, for sure, civil society, but also, and even more important, the future generation, youth, and all the vulnerable groups we discussed children, women, BIPOC, in order to design the most adequate responses. This means involving the right holders in choosing the right responses. The involvement of right holders should be the basis and at the core of new business and human rights legislation and corporate due diligence management system. This is part, as has Dusu said, doing what is right in the right way, because we are all in this greenhouse together. Many thanks for listening to me. Many thanks to all our speakers and participants, and see you next year for more intersectionality.
Thank you very much, Celine. And a last word to thank everyone again. I would like to thank all our panelists. I would like to thank all our chairs. And I would like to thank all the wonderful team of students who have been working really hard behind the scenes to make that conference happen. And of course, I would like to extend my warm thank you to our sponsors, PLMJ and the Portuguese Chamber of Commerce and Industry, and to our partners, CEDIS and Nova for the Globe. And with that, I will now close the first annual conference on business, human rights and sustainability. I hope you've enjoyed it, and I very much hope to see you again very soon. Bye-bye.